Hello and welcome to this video where we're going to do a couple of problems on bonds that are issued at face value. So I've made these problems available for you in Canvas in the week 2 module under supplementary information. And these problems will help you complete your homework. So let's take a look at these problems. We're only going to do the first two. So on August 1st, 2025, we have Gonzaga Corporation issuing 600,000 7% 10-year bonds at face value. Interest is payable on August 1st, and Gonzaga's year end is December 31st. So we have to prepare entries for the issuance of the bonds, the accrual of interest on December 31st, and the payment of interest on August 1. So, of course, we have a bond that's crossing accounting periods. Now, bear with me for a second. I should have resized my columns before I started recording this, but I did not. I forgot. So, bear with me as I resize these. So, it can just make it easier for me when I'm trying to do my entries. That's all. Format that to be a comma. And format that one as comma as well. And then, of course, let me make this bigger because I can't see it, even though it's right here in front of my face. All right, here we go. Now that's too big. Yeah, I definitely should have done this beforehand. All right, here we go. On August 1, I already read it. Let's do it. 8-1. On the day bonds are issued, the corporation receives cash. We have to determine the cash proceeds. Remember, we're not the bondholder. We are the corporation doing the issuing and we're selling the bonds. When we sell the bonds, we get cash. The amount of cash we get is determined based on the par value or the face value of the bonds multiplied by 100% or the percentage of issuance. But we were told these bonds were issued at face value. In some of our other problems, we were given how many bonds were sold and the increment. In this one, they're giving us the amount. So I don't have to really do any calculations. It's just the 600,000. So we're going to debit cash. Well, if you debit one thing, you got to credit something else because debits have to equal credits. The something else is bonds payable. Bonds payable. Always recorded at face value, which makes sense because my entry needs to balance. To record bonds issued at face value. Done. So that is A, the entry for the issuance of the bonds. Now, we speed up time. It is now December 31st, and we need to do the entry for the accrual of interest. Now, when we are accruing interest, this is an adjusting entry. So I would really do this with all of my other adjusting entries. It's not one of my regular general journal entries that happen throughout the year. But I know for my accrued expenses, I need to debit an expense and credit a payable. Well, this is interest. It's not quite time for me to make the cash interest payment. That won't happen until August 1st. But the bondholder has earned some interest. So I need to record that so that my financial statements are complete. We're going to debit interest expense and credit interest payable. Now, let's do the calculation for our interest. And I'll throw that over here. Now, for the calculation for our interest, I know that we need to take the face value or principal amount of the bonds. We multiply it times the contract rate of interest, which is given to me. And then we multiply it times the fraction of the year. So let me deal with what I know first. I have my 600,000. And we're going to multiply that by 7%. And then we are going to multiply that by the fraction of the year. Now, I have to count how many months there are from August through December 31. In my other problems, they made it easy. It was at the beginning of the year, and then the accounting period ended at the end of the year. This time, I got to count. So I got to go August, September, October, November, December. I'm looking at 5 months. So I'm going to multiply that by 5/12. Now, let me actually put my formula in here. Times 0.07 times 5/12. See what we get. All right, 17,500 is our magic number. 17,500. And this is to record the accrual of interest. Now, one more entry. We speed up time. I should have included the years here because 8/1/26. I forgot we were crossing years. And this one is 25. And then this one is 25. And then, of course, it's not big enough for you to see. There we go. All right, on 8/1/2026, it's time to make the interest payment. Now, remember, these are 10-year bonds. So it's not like we're paying back $600,000 at the end of year one. It's not like we're paying back 10,000 of the 600,000. We're going to pay the entire 600,000 back at the end of the life of the bonds. But the bondholders get to get the interest now. So we have to find the total cash interest payment. And we have to determine the additional interest expense. And we're going to take the interest payable off the books. I'll show you what I'm talking about. Let me deal with my accounts first. So I know I'm paying out cash because this is the cash interest payment. I know that I already recorded 5 months worth of interest on December 31st. So I'm giving that to the bondholder. I don't owe it anymore. I can take that payable off the books. I also know that from January all the way through July, I have another 7 months worth of interest that the bondholders have earned. And we're going to call that interest expense. Now, for interest payable, and I'm just going to put the calculation here over and over again. You don't have to do this part this way as long as you get the right numbers. So for interest payable, it's the same number that we calculated up here, the 17,500. But I want to show you that the fraction of the year matches up or goes hand in hand with the fraction of the year for interest payable, which goes hand in hand with the total amount of cash interest that we're going to pay. So, see if I can copy and paste my formula. Which I didn't do right. There we go. Now for interest expense, I'm going to take the 600,000 and multiply it times 7% again. But this time, instead of 5, I'm counting from January through July. And make sure you count all of July. That's why we get 7 months. So now, goodness gracious. I'm going to be lazy and copy and paste my formula again and just change that 5 to 7. Oh, we change that 5 to 7. We get 24,500 as the interest expense. Now, it doesn't matter which one you put first. You can put interest expense first or interest payable first, as long as all of your debits are first. It doesn't matter which one's first. Now, for the cash amount, that should simply be 600,000 times 7%. If I know how to multiply, that should be 42,000. But I should also be able to add up these two, and perfect. It adds up to 42,000. So there's more than one way to come up with the right answer. As long as your numbers are there, it's fine. Cash interest payment. All right. There you have it. The entry for when the bonds are issued, the entry for the accrual of interest at the end of the accounting period, and the entry for the first cash interest payment. Now, let's do the next one, 1013. And it's the same situation where I have this super big And this problem is very similar to the one we just did. The dates are a little bit different. All right. And again, I didn't resize my columns. And if I wanted to be fancy, I could edit this part out of the video, but I probably won't because if we were in the classroom together, we just do this part together. And it allows you to see how I'm manipulating the columns so that when you go try and do this, you won't have to wonder, how did she get her stuff to look like that? But you don't have to make yours look like this anyway. All right, January 1, we have Kirkland Company issuing 300,000, 8% 10-year bonds at face value again. Interest is payable annually on January 1. So we're going to do the same thing. Issuance, accrual of interest, and the payment of interest. And I should know to make my date column bigger. Let's see. Now, for this one, my first date is January 1. I'm glad I'm dealing with January 1 this time, so I don't have to worry about 5 months and then 7 months, and we'll use 2026. That doesn't look right. 2026. There we go. Now, when bonds are issued, the corporation receives cash. So we're going to debit cash and credit bonds payable. The amount of cash we receive is the 300,000 times the 100% because the bonds were issued at face value. Oh, too many zeros. Dang it. There we go. Bonds payable is always valued at face value, so I don't have to do a lot of thinking there. And that should be right because there's nothing else in my entry. And if I debit one thing, I got to credit something else for that same amount. The issuance of the bonds. Notice we don't do anything with the interest rate or the 10 years or anything like that. We just need the face value to help us find our cash proceeds. Now we speed up time. It is December 31st, and there's 12 months worth of interest that the bondholder has earned. We haven't recorded it, and they haven't received it yet because we make interest payments on the next day. So yes, they've earned it as of December 31st, but we don't give it to them until January 1, which is the next accounting period. So on December 31st, we have to do an adjusting entry, 12/31/2026, for interest expense and interest payable. We calculate our interest by taking the par value or face value of the bonds, and then we multiply it, sorry, I got to go back up, by, 8%, the interest rate. And we're told that interest is payable annually. So we don't really need a fraction of the year. You can put 1/1. I usually just leave it blank. And if I know how to multiply, it should be 24,000. Now, interest payable is just that same amount. To record accrual of interest. Now, the very next day, we're going to make the cash interest payment to the bondholders. So on 1/1/2027, we end up debiting interest payable because it's not payable anymore. We're paying it. And crediting cash. There is no additional interest expense because we've covered, or our accounting period has lined up with the period where interest was earned. So we're going to use that same 24. I don't have to do any calculations. I love this one. 24. Record the payment of interest. And there you have it. Try the first couple of problems in your homework. See how it goes. Reach out to me if you have any questions. I am going to save this completed file and make it available for you in Canvas as well so that you can access that and use that as a guide. I appreciate your time and attention. I hope you have a great, wonderful day.